right, guys. Welcome, Shaun, Seth, Joe. Part two of the New York City impacts of coronavirus, ETB, that we're recording on Zoom. So welcome, guys.
What's up, Peter?
Yeah.
Hey there.
So we've been talking about, obviously, this whole situation a lot. And what's organically kind of developed in our conversations is there are a bunch of dangers or obstacles that owners and investors need to navigate right now, and there are also a handful of opportunities. And so I thought in this episode we could talk about those, and then also with the goal basically being to help investors in the marketplace, get out of paralysis and give them information about what's really happening on the ground. So Seth, why don't we start with you and let's talk about some of the secondary and tertiary markets, because these are performing differently than the primary markets. Talk about the dangers in terms of collections right now, and what do you think some of the opportunities are for investors?
Sure. So what we've noticed so far is in the heavily stabilized neighborhoods, like, for example, the Bronx, we're seeing collections all over the board. It's a little different, actually, depending on who you talk to, but the sort of general average is right around 60%. At least that's what it was in April, and the numbers for May are just starting to trickle in. Mm-hmm. So people are obviously frustrated by that. In the better neighborhoods, they are, like you said, closer to 80 to 90%. I think people are attributing this to a couple of different factors. The market rate tenants, they could be employed, whereas some of the stabilized tenants could be in the service sector and are no longer employed, impacting their ability to pay the rent. Right? They have to make that decision of, okay, do I pay the rent when the politicians are telling me, hold off, or do you put food on your table for your family? So they're in a tough spot there.
Yeah.
100%. I think there's a kaleidoscope of reporting on collections, and it does depend on neighborhood. It can even depend on the building in the neighborhood. I think one of the things we found a lot of success in just sharing with owners is, sample tenant letters, which they've been very responsive to. I think on a fundamental level, most tenants realize, just like when you leave a job, you want to leave on good terms, and your history does follow you from place to place. And I think that's more front and center for free market tenants than it is stabilized as a matter of sentiment. But I do believe strongly that if owners are experiencing collections issues, one thing you can do is just make contact with each and every person in your portfolio. Empathy is a real thing. They need to understand that there's human beings on the other side of this, that the property owner is not a landlord lording over anything and is doing the essential work that is needed, just like everybody else, to get through this. And humanizing that relationship right now is an opportunity. And it might put your bill front and center as opposed to the cable bill and everything else that everybody has to choose to decide what to pay on.
Yeah, well, at times like these, everybody's reputation is really important. The tenant's reputation, the owner's reputation. Joe, you and I were just on a call where information was shared about an owner where he was contrasting how important his reputation and relationship was the tenants relative to collections. And this was in a building in the Bronx. Why don't you share what that was?
I think, that has a lot of effects on where we are and how landlords are collecting rent right now, because that landlord specifically is giving back and making sure he's being very transparent with his tenants and what's happening, giving real-time info, making sure everything is uptight and clean and neat in the buildings. I know a lot of clients that are giving back and providing masks to their tenants and any type of sanitary items, just to show that, we're in this together. And I think that's what's causing, his buildings to have better collections versus some other landlords. The other thing that I think is very noteworthy, I just got off a phone call with a client who owns 9,000 units across all the boroughs. And when we spoke a month ago, he obviously was very concerned with April, but May was a big concern for him, and it was going to be a lot more telling. So far, and he doesn't know the reason for this, May rents have been his collections have been better, slightly better, and he doesn't know what the reason is. What he is experiencing on some of the downtown properties, and what we talked about, Peter, you and I spoke recently about occupancy levels, that he's seeing a lot of, tenants break in their leases and renegotiating. And I think what he's doing is he's keeping them there, because you're much better off having that tenant in place at a lower rent today than keeping that apartment vacant right now and not knowing where the rental market is currently.
Okay,
so I don't know.
So Joe, you bring up a good point. Yeah, because that's the other side of this. It's almost like we're seeing the two dangers regarding this issue, is that in the secondary and tertiary markets, collections is the primary issue. And I think where that owner was going is, when you go to the primary markets right now, the question mark is less about collections, because many of those tenants can do their work virtually, and they're getting paid, or they have reserves and that type of thing. It's about, where is the renter demand, and where does occupancy go? So I know we've talked about just some anecdotes that you've heard in this category, and this probably, I would say, while this, we're in this period of dealing with the impacts of the virus, and does it end quickly? Does it come back? The renter demand, I don't know, talk about that, because I think that really isolates what one of the issues is.
Yeah, well, I think that's a good point to add to it. The renter demand, where you would see, rents not increasing so much on the Upper East Side, is more, depending on the location. You're starting to see that come up now, where it's closer to the hospitals. Workers need to be there so they can walk to the hospital. And I think you're going to see the same trend happen in Midtown as well, where you're close to work, because who knows when this comes back, what it looks like, and who's so comfortable to get on a subway or get in an Uber to commute to work. So I think if you wanted to be cool and live in Brooklyn and commute into the city, that may look different today.
Yeah,
so I think
it's a really good point. So it's all about what. Yeah, I mean, buildings. If you go outside of New York City, buildings have a walkability score, and you would think New York is the ultimate walkability, but this is almost taking this to another level. So maybe rents in Turtle Bay are going to go up now.
Right, and you could say the same thing for the West Village, which is already booming. But with the Facebook campus, Google campus, all happening there, you could walk a few minutes to work, and you're going to pay up for that apartment today. So you're going to see right there a lot of those markets increase.
So Shaun, if I'm a buyer, we've talked about these two different dangers. Like, what shows up to you as on the investing side as opportunity relative to both of them?
I think you got to watch where rents go, and I'd rather buy a blue chip stock after a couple quarters of bad earnings, and that's what I think the equivalent of buildings in established areas is, if you want to use the finance analogy. So I'm watching what earnings are really closely. I'm not necessarily going to peg a cap rate to this month's collections, because I'm a long investor, but I think, look, where we're experiencing the most action is in the established areas right now. Those are the deals I'm really pushing. We signed a contract in Fort Greene last week. We're signing a 40-unit building in Carroll Gardens today. We're signing a mixed-use building in Greenpoint, hopefully today as well. So things are happening. They're mostly happening in the established areas, and buyers are going to buy all the way down and up in established areas no matter what. I think that's primarily
the issue with the dichotomy in the market that we're talking about is that the more established neighborhoods, like Joe and Joe were referring to, can be fixed in a market rate economy. Like, that flushes itself out. But the secondary and tertiary markets that are heavily rent stabilized, in its own bubble, it's not a free market economy. So you have stabilization and you have politics mixed in with that. And that leads to a humongous question mark for buyers as to, it's an unknown. Right. And an unknown is a little scary if you're an investor.
Okay, so what at the beginning of this year, we were on the phone with an investor yesterday, and they were talking about how much has my value been impaired because of coronavirus, and we brought up the point that the bigger value impairment occurred for them decline in value occurred in June when the rent laws passed in 2019. That was the bigger hit to your value than what's happening with coronavirus. At the beginning of the year, we all thought that because owners were so punished in June, that by the time we got to this June of 2020, and the Rent Guidelines Board was going to put forth the rent stabilization increases, that we would get something that would be higher than what we've seen the previous 7 or 8 years.
Peter, don't you think it's an interesting, the politics here are really important. In 2009 to 2010, 2011, after the financial crash, we were not talking about collections in rent stabilized buildings to the extent we already are in New York City. Yeah. So, the issue here is we have a political fix that needs to happen. And one of the biggest worries, I think, on the minds of people is Bloomberg was the mayor of the city in 2009. Do we have the leadership to get through an economic recovery that we need to, or will the policies push these neighborhoods further and further into deterioration? And it's a real concern on the tip of everybody's mind right now when they think about some of the secondary and tertiary markets.
Well,
that's a common theme in most conversations that I'm having with owners. Politics and how are we going to get out of this when it looks better? What are vacancy? What are you going to underwrite vacancy at, right? And how that's going to look. And with restaurants, the stat that I heard yesterday is that 40% of the restaurants may not come back to the city. Mm-hmm. And that's a lot of jobs. That's a lot of, income coming into the city on taxes. That's going to disappear. And that's going to also, what else is going to disappear? If you have that retail tenant that was paying a portion of your real estate taxes, which are only increasing every minute, that's no longer happening. And that landlord who has to pay their mortgage and pay all the real estate taxes now is going to have a big issue. And that's what I'm seeing start to come to us and say, we need to talk about this because we need to understand an exit strategy.
Okay, so just to make that very clear, so you may have a retailer who's paying you $100,000 of rent, and they're also paying $60,000 of your tax bill. And to have that go overnight, that doesn't just bring your cash flow down to break even. A lot of the times, those buildings now are going to be running in a negative, especially if you have financing on them. So the point I was driving to, that Shaun, you were responding to about those neighborhoods, is that look, last night we got the preliminary votes from the Rent Guidelines Board, and they recommended a 0% rent increase. So the whole idea of how does the market come back is, how do you establish an NOI? And if we're in an inflationary environment, you've got stabilized product where now the government has put out what you just said about the politics that you're going to have no increases on your stabilized buildings. So how does that play out? Does it play out as far as an opportunity for anybody?
I think that if you're a buyer in the space, you are almost taking the view that, like the Civil War, there's going to be a reconciliation here. It's going to get bloody first, but ultimately it will force a reconciliation. Economy knows no politics, and you have to be long and you have to have the capital structure to deal with it. Mm-hmm. The two primary questions I'm encouraging all owners to really be asking themselves is, what are my capital needs? Do I have any debt maturities over the next 18 months, assuming credit continues to tighten, which it is right now, number one. And number two, is my partnership strong enough to deal through the carrying costs of this cycle, right? If there's 4 owners of a building that never had to necessarily, maybe they weren't making much on it, but didn't have to come out of pocket every month to feed it, and you got, collections down, you got taxes going up, are all 4 of those partners going to put in their 25% pro rata share for the next 18 to 24 months to get through the cycle? Because if not, you need to be having a conversation about how to deleverage and free up capital, which may only happen in a sale. And I think some of the seasoned pros that I'm speaking with and selling for discreetly right now are freeing up capital in anticipation of those needs and not getting in that perilous, paralysis fear kind of mentality. They're blocking and tackling.
Meaning, if you have to make a call between putting good money after, is it good money after bad or good money after good? You're going to have to decide, where should I invest my capital to keep a building going if I have to, if you just have to endure. I mean, history would say, if you own a building in New York, hold on, and you'll do well. But I think when you're in the eye of the storm, it's a lot more difficult to make those decisions. But we've all kind of talked a little bit around lending, okay? And I think the lending environment is, we're going to have to navigate it, but it's going to present huge opportunities for people. Joe, why don't you talk about like what you're seeing in that category? Just from,
Sure.
There's so many ways to go with this.
Yeah, before I get to that, I just want to touch on one more thing that you just said, Peter. A lot of operators and the guys that were raising money in the last 5 years and bought buildings to reposition obviously got affected by the rent laws big time because they couldn't add the value add strategy disappeared. And what I'm hearing from a lot of those groups saying, I understand it's not the right time to sell, but maybe it is the time to sell, get out, break even, come close to it, redeploy that capital into opportunities that are coming. And that may dovetail right into the next topic, which is lending and what's happening, and where there's a lot of loan sales coming to market that are not totally depressed values yet, but you're seeing loan sales, you're seeing the lending market obviously really tightening up while rates are very low. The issue comes down to what the NOI is and how they're underwriting, how the banks are underwriting it. So what are they using for vacancy? What are they using for the retail? If there's a retail component to it, how much are they discounting it? And that's really going to affect value. And what we're seeing to be creative with some owners, and we're doing this on a deal right now on the Upper West Side, where the seller is going to hold paper. And the reason that he's going to hold paper and go that route is twofold. One is he wasn't planning on doing an exchange, and it's a way to stretch out the capital gains taxes. And also, any buyer buying this right now is not going to get competitive. The banks are not going to get competitive on proceeds because the retail is 3 restaurants. Mm-hmm. So we could all, kind of figure out what it looks like.
Yeah, we know what's going to happen there. But if you're looking at this at the next 24 months of saying, okay, how can I prepare and gear up to buy? I would look at the constraints on lending to be one of the major areas that if you can solve that piece of the puzzle. So if you were syndicating deals and you were reliant on getting max leverage, you have to adjust that part of your business plan now, so you're less reliant on mortgages. Because and if you solve that, you actually have a strategic advantage over a part of the market that basically just doesn't have as much equity.
Big time. And I think a lot of owners, and Shaun had mentioned this in the past, are looking at, raising more equity, being able to buy all cash, come back into the market on a refi situation when the financial markets are much more robust, and you're able to lend at still, I think, competitive rates, because I think the rates will still remain low, and the credit markets will open up more. Mm-hmm. So that's where I see a lot of buyers having a competitive advantage. The families are going to make big splashes because of they've just refied a bunch of buildings. They have the cash to go out and buy at what they think are depressed values.
Right.
Everything will just be cash heavy on the front end, right? The mixed use opportunity fund, let me know when you guys are formed. I'm ready to go. Yeah. This is the buy refi. It's hard to peg it to, man. You look at these setups and you look at the retail rent, and it's very difficult when you put your buyer cap on to figure out where's the replaceable rent, how long will it take me to lease it, what's the tenant improvement, allowance. All these factors go into it, and it's shaping up to be an all cash type of environment. Look, there's great opportunities, and we're not fire selling anything in some of these good neighborhoods, but this is where the opportunity is that still can be hedged with the apartment, factor above, which can always be underwritten. There's always a need for somewhere, to live in New York City.
Yeah. Well, two things. When you bring up restaurants, and I was talking with a restaurant operator about this actually, and he said the first guidance from the government is that we can open up a restaurant at 50%. He said right now we're not opening and we're losing money, but we're not working and we're not running the kitchen and paying the expenses. He said if we have to work, open up the restaurant, buy all the inventory, run the kitchen, pay for everything, and we can only open up to 50%, we will actually be working, spending more, and losing more after doing all that. So it's better for us to just stay closed until we can open at 100% and actually get people there. So I think this is probably one of the most difficult avenues or kind of parts of this whole thing that's going to have to be navigated, is what restaurants open. The ones that do open, once people feel comfortable, if they're going to have much less competition, so there's big opportunity on that side. But but that's a real question. Seth, talk about, I would say probably the biggest thing that we're getting, the biggest question that owners, that comes up in conversation, I should say, is just about, I'm not really sure what to do right now. And, the whole idea here is, just to talk for a few minutes and share the feedback and the market data and the thoughts that we're hearing and sharing with others. Talk about that, I guess, a little bit, particularly if I'm thinking about selling now and maybe buying something else, and I'm just not sure if that's a good idea. What are the parts that how are you seeing people navigate that thoughtfully?
That's a tough question to answer. What should people do? But it's really case by case. I think the first thing I would be doing is I would be talking to my lender. If I have a building that I'm considering selling and I have a mortgage on it, I would absolutely be talking to my lender. If my loan is coming due, which a lot of loans are, if you bought a building in the last few years, your loan is either coming due or your interest only is burning off. Mm-hmm. So you weren't paying down any principal, and banks are tightening up their underwriting. So I would be getting out in front of that right now, mm-hmm. because I think that's going to be a theme later this year, where people are going to have a little bit of a difficult time.
Joe, what about, what the owner you were just describing, where they were getting in the mindset of saying, look, if I have to sell and I sell lower, and as long as I redeploy that money back into the market, I may actually do better.
Yeah, we're seeing that as a common theme amongst a bunch of owners. A lot of people are also saying, I don't want to do anything right now until the dust settles. Listen, we don't know when this dust is settling. What I'm seeing a lot of smart investors do, and guys and owners that were planning on selling in the next 3 years, getting out in front of it now, because there are deals like Shaun mentioned, the blue chip stocks, the well-located assets that still have value. And we're about to put one under contract today in Soho, which is probably only off about 5% on price, on value, where it would be pre-COVID. And it's got vacant retail. When I say vacant, they're there, but they're not paying. So, and it's a restaurant and a bar. So that buyer is looking, every buyer is looking at different angles and have different mindsets. He specifically is looking at it long-term. And this is just a blip in time, whether it's a 6-month blip, 3-month blip, or a year blip. He's owning the building for the next 20, 30 years. Mm-hmm. So there are buyers out there for these type of opportunities, even with, heavy retail components or vacancy upstairs. It's really, it was interesting how much demand we had just because of the location and obviously the opportunity to buy a building that's been in ownership for 60 plus years.
Right. This is an opportunity to upgrade your location and the quality of real estate. If you're concerned about selling at a slightly lower price today, it might be a home run a few months from now. We don't know. So if you can sell now, free up some cash and position yourself for opportunities that are going to be coming, I think that's a no-brainer. And that might not even be in the real estate market. That could be in a totally different vehicle or sector of the market that you don't know yet, but cash is going to be king. That is for sure.
Mm-hmm. Yeah, I would agree. What should owners be doing right now? You need to be anticipating the worst, right? We're all optimists. Get out of the mindset sometimes that selling is a defeatist exercise. It's not. So figure out what your capital needs could be in the next 18 months, assuming credit becomes very difficult. That's the assumption I'm making personally. You have to assume credit will get tight. If you have a maturity in the next 18 months, you need to be speaking with the broker on the debt and the sales side calling us up. What's this worth right now? Peg it to the real mark-to-market value, because things are moving. But understand that, it might still take time. And honestly, people selling a building today is like bringing an IPO to market. The level of diligence and prep work required is enormous. And we are taking listings right now and getting all that organized for launch in July, August, September. You need to be on the front end of the organization. And, us as brokers, we can't work on everything right now either. We're really pushing hard, but only focused on a few things. And, it's going to take an enormous amount of effort to push things across the finish line. But, that's where these relationships come in.
I would also add to that. If you have a retail tenant that is struggling right now, and most of them are, I would use this as an opportunity to renegotiate and extend their lease. And why that's important is because you can get, if the retail tenant is there and just dealing with the current situation, you can get paid on that from a sales perspective in some capacity. If you have a vacant retail space, it's worth nothing on a sales value right now. So if you can negotiate with your retail tenant to give them some sort of forbearance or short-term discount on the rent in exchange for an extension, I think that's a smart move right now.
Or better said, right? You got 2 years. I'll give you a 50% discount in the next 2 years. I need the money up front today.
Yes, exactly.
Yeah, well, you're reminding me of an owner we were speaking to yesterday who had a liquor store, and liquor store is essential service, and they're actually doing a very high volume of business right now. So it all depends on who the retailer is. So guys, this was great. We shared a lot of good information here, and we'll probably do another one of these. We'll do part 3 because this is just, the whole marketplace is evolving so rapidly. So anything I missed?
Yeah,
No, I think it's all.
New York City is still standing. It's still there. It still looks great on a sunny day. There's opportunities here. Stop watching all the news all the time.
Yeah, that's true.
We're here for real-time data. Comps a couple of months ago don't matter. So if you want to know what real trades are happening and what levels, feel free to reach out. Everyone be well, and nice seeing everybody on this call.